Welcome back to Vantage. We've got a manager who's returning to the show. He's based out in the US. He focuses on international small cap equities. He's all about finding high quality companies. Let's go take a look. Welcome back to Vantage. Unusually, we are recording remotely, but it's worth it. We've got a manager returning. He is based in the US, so I couldn't fly all the way out there, but I'm delighted to have him back on the show. Mark Fischer, welcome back to Vantage. We spoke to you, I think, in the fourth quarter of 2021. And before we get into it, why don't you remind everyone, what you're all about?
Neil, great to be back. Thanks for having me. So I'm a portfolio manager within Royce's four-person international team. I'm based here in New York. And with me on the team, we have Mark Rayner, another portfolio manager in London. And we have two senior analysts, Evan Choi, who currently resides in Chicago, and Yutetsu Amitani, who's based in Hong Kong. We invest exclusively in listed smaller companies that are located outside of the US. And international smaller companies, we think, is a really interesting asset class. It's very large. You have literally thousands of companies. It's diverse, whether by products or services offered, whether by business models or levels of quality. And it's also inefficient. And I would argue it's perhaps one of the last inefficient frontiers. You have markets like Japan, say, where it's not uncommon at all to find billion-dollar market cap companies with literally no sell-side coverage. So these characteristics, we think, make an ideal hunting ground for stock pickers. And so now, of course, all long-only stock pickers want to invest in companies whose stock prices are going to rise. That's pretty obvious. But there are lots of different ways to try to achieve that. And so we expressly don't buy stocks where our best guess is that the stock price is going to rise, because frankly, we think that's just too hard to get consistently right. Rather, we want to invest in companies where we think value creation will consistently be had over the long term. That's easier to analyze. And over the long run, we think it's value creation that ultimately drives price performance. So if you like, we're investing in the cause, which is the value creation, and not in the effect, which is the share price appreciation. There's this iron law that says that the only companies that create shareholder value are those where their returns on invested capital exceed their cost of capital. And so that's simple maths, really. So we're looking for value creation, and logically, because of that, we only invest in companies that we believe will be able to post superior and consistent returns on invested capital over time. We then try to combine that with attractive growth, conservative balance sheets, and reasonable valuations, with the intention of really owning these businesses over the very long term to enjoy the power of compounding that these businesses really harness. We call it quality at a reasonable price, or QARP. And so we've developed a very detailed, disciplined process to help us achieve that. And it really has two elements. One is something we call the customer test. And here we say that the relationship that a company has with its customers is crucial, because ultimately it's the customer who decides. So we've developed a very specific set of questions that help us understand what the customer benefit is that a company provides, and help us really vet that a company has a customer base that cannot exert pricing pressure over our companies and that is inherently loyal. And the second pillar is something that we call enterprise quality scoring, or EQS. And here we perform quite an exhaustive list of analysis where we look at a range of business model characteristics, everything from the structure of the market to the competitive advantages, to the operational excellence and financial track record, to the environmental, social, and governance characteristics. And then we score each company numerically out of 100 on those attributes. Only those companies that score 70 and above are then eligible for our portfolio.
Excellent. And I mean, if we say that the last time we spoke was Q4 2001, I mean, we've had that 2022, which a lot of people want to forget about, and all the sort of geopolitical and macro turbulence that went with it. How did a strategy of like yours sort of fare in that kind of environment?
Yeah, so 2022 was indeed a year of turmoil, both politically, macroeconomically, as you mentioned. We began the year with worries over inflation, and then it culminated in a spike of bond yields, which was more or less unprecedented in recent times, with the 10-year rising from about 1.5% the beginning of the year to almost 4% by year end. So quality companies, which are defined as those with the highest returns and strongest balance sheets, have counterintuitively actually lagged in 2022. So if you look at the factors or attributes that were most advantageous in 2022, you actually found that investors favored companies that had higher leverage and lower returns on invested capital. And in fact, those with the highest financial leverage ranking in the top quintile outperformed those in the bottom quintile by over 340 basis points for the year. This underperformance of high quality small caps has now persisted for a few years, most notably since the onset of the pandemic. And the magnitude of this underperformance is quite remarkable, actually. Global high quality small cap stocks, those with the highest decile returns, are lagging the overall small cap market by magnitudes not seen in about 15 years when measured by their 3-year price performance. So it's quite remarkable.
I mean, it seems so counterintuitive in that, you know, when you've got elevated risk, you'd expect to see some kind of flight to quality. So, can you dig a little bit deeper and help us make sense of this?
Yeah, that's a great question. As we've mentioned, I think we're of the firm view that in the long run, value creation is what drives share price, and the two correlate. So if you like, quality is the long run stock price driver, but that's certainly not the case necessarily over shorter periods of time. There are a number of other drivers. There's various thematic preferences. There's preference for value or growth. And over the last 3 years, these drivers have taken turns in really driving stock prices. So 2020 and 2021 were, of course, the years of the pandemic. And depending on investors' views of the likely direction of travel, the market jumped between healthcare stocks, work from home beneficiaries, and then reopening plays, the airlines, the hotels, the pubs of the world. And all the while, valuations for growthier stocks just went through the roof because they benefited from near zero interest rates. 2022, in contrast, was a year of inflation concerns, as I mentioned earlier, resulting rise in interest rates. And we feel that the market played this thematically in two ways. One is that to protect themselves from rising interest rates, investors bought into value stocks in 2022. So companies with the lowest multiples have consistently outperformed. Attribute that you really wanted to have in 2022 was a low price to book ratio. And in fact, in the international small cap world, the companies with the lowest price to book ratio, those falling in the bottom quintile, outperformed those in the top quintile by a whopping 23.5 percentage points. So that's quite remarkable. And then the other tactic that investors played beyond just looking for low multiples was to invest in industries that they perceived to be direct beneficiaries of inflation. So the energy companies, the utility companies, commodities and banking stocks, business models that are not traditionally associated with attributes such as high returns on invested capital, strong balance sheets. So the quality companies that we look for have struggled to gain investor attention for around 3 years now, which is an unusually long time period in our experience. And that's despite very robust operational performance.
So it sounds like a sort of challenging time for investing in quality stocks over the last 3 years. I guess, what's your guidance in terms of what do you think is going to change that, and Actually, what's going to be the catalyst for the return to quality, people focusing on those names?
That's the $1 million question, isn't it? We're generally quite reluctant to forecast future price performance. Again, as I mentioned, that's not our forte. But with that said, I would say that we're quite confident in the future of high quality international small cap stocks. That optimism is underpinned both by past performance patterns, but also by operational realities that I think are going to become increasingly important this year and beyond. And that will also become exceedingly difficult for investors to ignore. So firstly, international small cap equities in general are an asset class where if you're genuinely a long-term investor, you typically produce good outcomes over time. If you take a hypothetical investor who had invested in our international small cap benchmark at the inception of that benchmark in the 1990s, that investor would have achieved positive 5-year price performance in over 80% of monthly rolling periods. So that's quite consistent positive price performance. And by the way, those same returns would have also exceeded the performance of large caps in 80% of monthly rolling periods. But if you're a quality investor, you could have and you would have done even better. So again, over longer periods of time, the 5-year price performance of global high quality small cap stocks, again, those with the highest decile of returns, has over the past 2 decades beat the overall small cap market in over 90% of monthly rolling periods. So this tells us that the environment we're in currently with underperformance in quality is the exception, not the rule. And that in the long term, the market honors the power of compounding that these quality companies can harness. But beyond this empirical data, there's this operational reality. And I think that operational reality increasingly favors small cap stocks. What I mean by that is simply when you're in a difficult and challenging economic environment, the companies that are simply best suited to weather that environment and indeed emerge stronger are those with the most compelling quality attributes. And so to elaborate on that a little bit, if we reflect on the key topics that are actually impacting companies financially, operationally in this environment, you have inflation. So what do you want in an inflationary environment? Well, you want pricing power. You want businesses who can take the increase in their costs and pass it on to their customers. And you want those customers to accept those price increases and not leave. And that's what our customer test is all about. Secondly, you have rising interest rates. Again, what do you really want when rates are rising? You want strong balance sheets, because then you can absorb those cost increases and you can continue to remain competitive, invest in your business, acquire smaller companies and gain market share while your competitors are struggling and spending all their financial capital on servicing their debt. And so again, our portfolio is net cash. Almost 60% of our company's balance sheets are in equity. Then you have the consumer cost of living crisis. You have consumers, especially in Europe, that are really feeling the squeeze of inflation. We rarely invest in consumer-related businesses because, again, consumers tend to be fickle. You have supply chain disruptions, and this has been quite remarkable, actually, over the last few years. We're seeing those disruptions abate to a degree, but inputs are still expensive and unavailable. And our portfolio is extremely asset light. We think something like 60% of our holdings have inventory less than 5% of sales, and 30% have no inventory at all. Again, we have no exposure to the region. And lastly, of course, there's a looming recession. And the big question is, will it happen? How bad will it get in various places of the world? But importantly, when you invest in a quality business, these are businesses whose products and services will be in demand come rain or shine, because they're selling low-cost, mission-critical items. They generate high degrees of recurring revenues. And so when customers' budgets are slashed, quality companies tend to stay out of the line of fire.
That's That's a really interesting, and I particularly like the this point about the discrepancy between operational strength and the pressures in pockets of the market. Um, can you bring that to life with maybe talking about a couple of companies that you've invested in for our audience?
Sure. Yeah. So one of the companies that I would highlight is a UK listed company called Intertek. And interestingly, the business actually traces its roots all the way back to the end of the 19th century with a lamp testing center that was set up by Thomas Edison. But fast forward today, it's one of the global leaders in providing outsourced testing, inspection, and certification services. So what does that mean? It means that Intertek helps its customers inspect and reduce risk in its operations and supply chains. And then it also tests and certifies the quality of a wide range of different products. I mean, everything from the clothes that we wear to the medicines that we consume to the electronics that we take for granted every single day. And we like this company because these services are absolutely mission critical. I mean, they effectively safeguard the integrity of their customers' products, their customers' assets. They ensure compliance with laws and regulations, and ultimately, they help their customers protect their reputations and their brands. But yet, these services make up less than 2% of the cost of those products that the customers are bringing to market. So they have quite minimal incentive to be price aggressive. So now Intertek serves over 400,000 customers, none of which makes up more than a low single-digit portion of their sales. And these customers rarely ever leave. And that's because once Intertek it serves you, they become deeply intertwined into your operations and your supply chains. So, for example, their testing labs are actually often co-located in their customers' factories. So all of this produces a very predictable stream of revenues. And when you combine that with high teens profit margins and a very asset-light model, you get really strong and consistent returns on invested capital. Now, in the long term, what excites us also about this business is that it has a very compelling secular growth opportunity because this testing, inspection, certification market globally is only 25% outsourced and growing. So when you have market leaders like Intertek that still has 3/4 of the markets that's up for grab, that provides a multi-year runway of growth. And on top of that, even though Intertek is one of the global leaders, its market share is still mid-single digits. So it's a highly fragmented market. And we think that that means that it can consolidate the market and gain share. Despite those attractions, though, Intertek's share price last year was down some 30%. Now, is the company worth 30% less now than it was before? We really don't think so. Sales and profits were expected to have grown in 2022. They're expected to grow in 2023. The business has been operationally resilient. It has pricing power. So really, it's experienced significant multiple compression along with much of the high quality universe. And we think that as investors begin to refocus on these really high quality business fundamentals, that this is a stock that could be quite handsomely rewarded.
That's great. And is there any others that you wanted to draw our attention to? We don't have to.
Yeah. How about I mention Restore? Restore is another UK listed business. It's a support services business, and the main business that it has, which represents some 70% of sales, is profit rather, is called records management. And here, what they do is they provide these storage and retrieval solutions for paper and other corporate documents to around 6,000 clients within these really secure out-of-town locations. They hold literally millions of documents in these storage boxes and have long-term contracts with their customers that last about 5 years. So what that means is they have this really repeatable annuity stream, really, of revenues, and they hold these boxes often for 20 years or more. Now, box growth is only 1 to 2% per year, but when you combine that with price increases, it's a hugely sticky and repeatable business, and it's growing on average, mid-single digits organically every year. Now, what makes it interesting is that they use the cash from this very reliable records management business to then invest in complementary businesses like document shredding, scanning, installing and recycling of office IT, and relocating offices. And these are all areas where there are natural cross-selling opportunities. Now, none of this will sound technically complex to you, but this is a business where scale really matters, as you can imagine. It's all about route loop density. And so being the number one or number two in each of the markets in which it operates, it has a massive scale advantage. And that means that it can provide these services at a lower cost and a higher quality than its competitors can, and also than its customers can. And that creates a really compelling value opportunity for customers. The other thing is that these are extremely fragmented markets. Again, the company has a teens market share within its overall market, despite being, as I mentioned, the number one or number two. So again, this is a business that, because of its very consistent revenue stream and its highly cash generative model, can just continue to buy smaller businesses and also organically gain market share. So despite these qualities, again, the stock price declined in 2022. Valuations flirted with multi-year lows. And we can only presume that this is because of a lack of 2022's thematic drivers being associated with the name. There was a very recent trading update which suggested that they had a strong result for 2022 and suggested further optimism for 2023 and beyond. So this is a business operationally that we think is, frankly, a sleep at night company, one of those businesses where if we fell asleep for 10 years or if the stock market shut down for 10 years, we would be very comfortable that it would be in very good shape when the stock market reopens.
Yeah, and there's two great examples of finding interesting niches where you've got dominant market shares and high quality companies operating in that space. Mark, it has been really, really good getting you back on to Vantage. I think I would summarize it as keep the faith. So it's been a challenging 2 or 3 years for investing in high quality small cap businesses, but you do it because there's this vast pool of companies, you're finding these interesting niches, and ultimately, I think you're right that the market will return to its calling of leading at those kind of companies where return on capital continue to exceed cost of capital. You'll see that reflected in their valuations in due course. Pleasure having you on. I hope you make a trip to Europe and we can do it in person next time. And I'm sure our listeners will find it interesting. Thanks very much for joining.
Thanks for having me.